Welcome to the third lecture in the finance series. In the third lecture, we will be talking about IPOs. Do you know the difference between primary and secondary stock markets? Please pause the lecture video to try to answer this for yourself first. In a primary stock market, investors purchase newly issued securities. In a secondary market, investors trade previously issued securities. What do you know about IPOs? Please pause the lecture video to try to formulate an answer. The IPO process is colloquially known as going public. An initial public offering or stock market launch is a type of public offering in which shares of a company usually are sold to institutional investors that in turn sell to the general public on a securities exchange for the first time. An important concept to know about with regards to IPOs is the prospectus. When a company wants to go public, they need to create a prospectus. The prospectus discloses details of the offering and the company to potential purchasers. It needs to be approved by the Securities and Exchange Commission. What is an underwriter? Please pause the lecture video to try to answer this for yourself. The word underwriter comes from the practice of having each risk taker write his or her name under the total amount of risk that he or she was willing to accept at a specified premium. For example, the term underwriter is common in the insurance business, where the underwriter accepts to insure the other party for a certain amount of money in exchange for a premium. Usually, companies undertake an IPO with the assistance of an investment banking firm or a syndicate of investment banks which act in the capacity of an underwriter. Company offering shares, the issuer, enters into a contract with a lead underwriter to sell its shares to the public. The underwriters help correctly assess the share price and establish a public market for shares. There are several advantages and disadvantages to the issuer. Through this process, a private company transforms into a public company. Initial public offerings are mostly used by companies to raise the expansion of capital, possibly to monetize the investments of early private investors and to become publicly traded enterprises. A company selling shares is never required to repay the capital to its public investors. After the IPO, when shares trade freely in the open market, money passes between public investors. Although IPOs offer many advantages, there are also significant disadvantages. Chief among those are the costs associated with the process and the requirement to disclose certain information that could prove helpful to competitors. Risk involved for the underwriter depends on the type of underwriting that is agreed upon with the stock's issuer. The two most common types of underwriting are bought deals and best effort deals. In a bought deal, the underwriter purchases a company's entire IPO issue and resells it to the investing public. In this case, the underwriter bears the risk of selling the stock issue, and it would be in his or her best interest to sell the entire new issue, because any unsold shares then continue to be held by the underwriter. The amount of compensation the underwriter makes represents the spread between the price for which the underwriter acquired the stock from the issuer, usually a discounted price, and the price for which the underwriter sells the stock to the public. In a best effort deal, the underwriter does not necessarily purchase any of the IPO issue and only makes a guarantee to the company issuing the stock that it will use its best efforts to sell the issue to the investing public at the best price possible. Unlike a bought deal, there is no consequence for the underwriter if the entire issue is not sold. It is the issuing company that is stuck with any unsold shares. Because there is less risk involved, the underwriter's gains are limited even if the issue does sell well, because in the best effort situation, the underwriter is compensated with a flat fee. Who is paying what is called the IPO price? The investing public or the underwriter? The underwriting institutional investor, which could be a company like Goldman Sachs or JP Morgan Chase, pays the IPO price. The institutional investor then sells to the general public on a securities exchange at a price set by demand and supply. The lead underwriter for the 2012 Facebook IPO was Morgan Stanley. Goldman Sachs was also an underwriter. The IPO price was set at $38. This is the price that the underwriters paid to Facebook. As you can see here, the investing public almost immediately paid a lower price, as demand was low at the 38 IPO price. Another way to do an IPO is through a Dutch IPO. A Dutch IPO allows any investor, whether or not this investor is institutional or private, to put in a bid over the web for a certain number of shares at a certain price without knowing what others are offering to pay. It is modeled after the style of auction used to sell tulips in the Netherlands. Let's look at an example. Let's say a company wants to go public and its goal is to sell 100,000 shares. The following bids have been received. Aragorn Mutual Fund would like 20,000 shares at $50 per share. Frodo Mutual Fund put in a bid for 20,000 shares at $55 per share. Gandalf Mutual Fund put in a bid for 50,000 shares at $70 per share. And finally, Pippin Mutual Fund would like 30,000 shares and is willing to pay $75 per share. The goal of a Dutch auction IPO is to sell an allotment of shares at the highest price that would result in selling the entire allotment. Since the company is trying to sell 100,000 shares, what is the highest price that would result in selling 100,000 shares? Please pause the lecture video to think about this. The correct answer is $55 per share. There can only be one share price. At $55 per share, Frodo will buy 20,000 shares. Since Gandalf and Pippin were willing to offer more than $55, they will also purchase their allotment if they only have to pay $55. So Gandalf gets 50,000 shares at $55 and Pippin gets 30,000 shares at $55. Altogether, the company can sell 100,000 shares at a maximum IPO price of $55. Aragorn Mutual Fund does not get any shares. There was a very famous Dutch auction IPO in 2004. Can you think which company this might relate to? It was Google. Google was hoping to sell 26 million shares and bids could be submitted for as few as 5. Google was really trying to give ownership to the many consumers that had helped Google grow into the company it had become and to take the gains away from Wall Street. The Dutch auction IPO was disappointing for Google. Google was not able to sell the number of shares it had wanted to sell. The price was also significantly lower than what Google had hoped for. Please look up Google's stock price today. Do you think early investors made a wise decision? Can you name any of the largest IPOs? Please pause the slide to think about this first. Here is a list of the 10 largest IPOs. The first 4 relate to Asian companies. This concludes the lecture on IPOs.